Hello and welcome to Strategic Alternatives, the RBC Capital Markets podcast. We're here today to uncover new ways to raise capital, drive growth, and create value in an ever-changing world with insights and outlooks from the RBC Capital Markets team. I'm Vito Sperduto, Global Head of Mergers and Acquisitions, and as always, I'm joined by Larry Grafstein, Deputy Chairman of Global Investment Banking. Hi, Larry.
Great to be here, Vito.
And today our special guests are from our consumer and retail team. Douglas Trauber is Global Head of Consumer and Retail here at RBC, and Hugh Paisley is the co-head of U.S. Consumer and Retail Investment Banking here at RBC. Douglas and Hugh joined us almost 2 years ago, and I know it's been a very active period over the last 2 years with their clients and across the space, and so we're looking forward to hearing those perspectives today. Douglas and Hugh, welcome to the podcast.
Great to be here. Thanks, Vito.
Looking forward to it, Vito.
So let's start off, and I think just to kind of level set, we've talked a fair bit in recent podcasts about what we saw in 23 and how that leads into 24. And so just for our audience, if we think about the overall market, last year was the first year where global M&A volumes were below $3 trillion since 2013. So it's been about 10 years. We've had at least $3 trillion of value, peaked in 21 at about $5.7 trillion. And last year was about $2.9 trillion. So seems like not a big drop off, but certainly we all expected greater volume and we saw a nice pickup in the second half of the year. A lot of the green shoots and deals that we saw in the broader M&A market have been corporate transactions, primarily in the highlights have been some large deals across energy and healthcare and the like. And in the US market, we've certainly seen that the corporates had a nice pickup last year and the private equity firms probably, we're off about 17 or 20% in terms of volumes from what we saw from a deal perspective. Douglas, why don't we start off and give us some perspective on what you saw in the consumer and retail space in 23 and especially how the year ended up and how it's sort of going into 24.
Let's start with the consumer, because I think taking a little bit of a halo back to where we've been in the last 4 years is important. If you go to 2021, and in just the beginning of 22, we were in a very unique situation with the consumer. Let's focus on the mid-market and lower-end consumer. It was a unique period in that we were all at home, and so we had less spending. And what happened over that 2-year period was those consumers drove their savings levels to recent highs. As we moved forward, though, during that period of time, two things happened. One is the easing of the money supply drove demand, and we had significant supply constraints as a consequence of manufacturing closures, both in the US, but in particular in Asia. And also a lack of labor. We drove inflation because of demand versus supply, and we entered into 22 in a different situation. And that situation was unprecedented inflation, as well as rising interest rates to try to stop that. On the inflation side for the consumer, that really choked off that discretionary spending over that period of time. So if you look today, at the end of 23, what we have is a consumer that on a basis of their non-mortgage interest expense as a percentage of discretionary income is the highest level we've seen in, it's near its historical highs. And that's a consequence of both the driving the inflation down, but also the rise in interest rates that causes the credit card debt, the auto loans to go higher.
And larger banks, Doug, are now reporting that credit card debt is reverting to pre-COVID levels.
Absolutely. So we've got a consumer that's stretched, and we've got corporates en masse that are hovering near sort of zero same-store sales. Within retail, we have discretionary sales that are negative, and we have consumable sales that are, while they were strong, and I'll come back to this later, in terms of the fortification of our corporate clients and their balance sheets and their strengths and their EBITDA and what they can do with that. The overall picture is one that's normalizing into 23. Third-party retail, scale is important. Value offering is important. Convenience to the consumer is important. And in a world of where we are now going forward in GDP growth, we're at the top of the proverbial mountain. And I say that because grocery, for example, grew top line sales between COVID into 23, 20+%, decelerating, as I mentioned, and it's about flat today. They grew EBITDA at a higher rate as a consequence of scaling that sales growth. And as a consequence of the free cash flow, was able to pay down debt, pay higher wages, and pay other stakeholders for distribution. And looking forward from this past year and out towards a no growth back to GDP outlook for grocery, for example, we saw M&A activity.
Yeah. So, I mean, just to take a step back, Doug, you have this situation where it's almost, especially for public companies, that growth was quite robust because of some of the idiosyncratic factors associated with the pandemic. And now you have a combination of rates going up, maybe the consumer getting squeezed a little bit by the higher costs you referenced, and at the same time, pricing power coming down. And so it really raises an inflection point issues for companies, of all sizes, especially in the public markets.
Without a doubt. So let me give you an example. And that goes to what I call balance of power. And this is going back a little over a year, but the Kroger-Albertsons transaction that was announced. The logic for that transaction is if I'm a GDP grower and Kroger spent 15 years investing in price to get closer to Walmart, to be more competitive. They've invested in their infrastructure to become more omni-channel and for the experience. Given the competitive dynamics of the marketplace, to further that investment, they need scale. They need to leverage that scale. They need to enhance their ability to drive down a procurement. They need more ubiquity nationally to help drive other services, but both logistics with their own, drive manufacturing, but also their retail media network. So this is an example of creating the scale and creating and leveraging the free cash flow from this to drive efficiencies and not duplicatively with their competitors, to enhance their competitiveness against and lower that gap to Walmart and to drive growth.
Douglas, I think those are all great points. I think one of the things as we sit here on January 25th is obviously this morning when GDP figures were announced for the final quarter of 23, we saw that GDP increased at a 3.3% annualized rate, which resulted in a 2.5% growth for all of 23. And so clearly ahead of what Wall Street was expecting. And when we think about sort of some of the drivers there and some of what it means for the consumer, we also got some great news that from a consumer perspective, there was some strong spending on their part that helped drive expansion. And I think it was like a 2.8% personal consumption expenditure increase in those numbers. So a lot of data, but again, the signs are feeling good. And I think the consumers feels like they're continuing to spend. We'll see how that goes, especially as rates stay higher. And so, that's going to increase costs in terms of any mortgage rates or debt that they have out there. And does that impact their spending on a go-forward basis? But certainly some positive news, especially for a lot of your clients. Hugh, tell us a little bit of what you're seeing in this environment. How are your clients feeling as they're heading into 24 and their mindset from a consumer perspective, the economy and the like? What's impacting them?
It's a good question, Vito. I think that, as across specialty retail, which is my area of focus and coverage, it really depends on which subsector you're covering. I think for instance, in the home furnishing segment, where you saw a tremendous pull forward of demand in 21 and 22 from the stay-at-home and trends related to COVID, you saw some whipsaw on gross profit margins with delays in container shipments, creating promotional demands. And what you've really seen is 23 was, hopefully a more normalization year from the trends from the whipsaw of the last 3 years. And as you look out to 24, I think the real question for home, which tends to be much more discretionary, is what is the strength of the consumer? There will be pent-up demand. There is millennial and Gen Z housing formation, which certainly creates tailwinds. But, I think the question is where is the strength of the consumer? And, as we look back in 23, there was a tale of two halves. The first half where it looked like we were moving towards a recession and a hard landing. And I think that now we're starting to feel a little bit more optimistic. And I think this builds on, Vito, what you were just saying in terms of the GDP print, is that the consumer seems to be resilient. And I think that The unemployment rates are a good stability factor, and we are going to see some signs of return to discretionary spending. We see that in the services sector. I think about areas that were very active in M&A, like the fitness market, med spas, where consumers are spending for more experiential. They want to get out of the house. Certainly, we saw that in travel and leisure. Those are the areas where we see a lot of activity and a lot of investment dollars. And, I think as we look out over the next 12 to 24 months, we're going to start to see some of those sectors that haven't been as active get active, simply because there's been a number of private companies that need to find their next transition that might be sponsor owned. There's family owned businesses that are looking to raise more capital. And there are e-commerce companies where we've seen, from an environment where there were low rates and money was easy to money now being hard and a lot more competition in those sectors, and they need to find larger homes to be a part of.
I do want to just ask you, Hugh, because the one thing common to all retail clients is the concern about a recession. And as you say, the concern seems to have moderated compared to maybe a few months ago. But as a retailer who's very sensitive to these cycles, how are some of your clients managing that uncertainty right now? And how does thinking about deals fit into that?
That's a great question, Larry. I mean, and again, it comes back to which sector are you in? There's certainly a cautious approach. There's a greater focus on expenses and managing through that. But there is also an underlying tone of needing to prepare for the future. I think one of the big things in terms of consumer trends that we're seeing is this demographic and channel shift. And it was pronounced during the e-commerce. It's something that we've tracked for a long time of how e-commerce has grown, how omni-channel has grown. And really, as we think about what the future of retail is, it's adaptive retail. And that's where you're using the tools of technology like AI to really analyze and what the consumer and each individual consumer wants and demands, and be able to use predictive technologies to streamline not just what the customer sees on the e-commerce site, but also understand what the consumer is doing in the retail store and bringing that back to what the supply chain is. And so, I think that all of that comes down to investment dollars. And so depending on who you are and what investments you've made, you've got to look at how do I grow my revenue? How do I continue to be relevant to my consumer? How do I manage costs? And are there capabilities out there that I can build organically? Or do I need to seek external ways of capturing that, whether that be through M&A or strategic partnerships?
Hugh and Douglas, I know you both just got back from spending 3 full days down in Orlando at the annual ICR conference, which I believe is the 26th annual conference that they've held down there. And, with the number of public companies and private companies that attend, and especially the time of the year just after the holiday period, it's probably a great indicator in terms of how everybody's feeling and what the sentiment of your clients are going into the year. What was the tone down there, and were there any big themes that everybody was talking about as they're looking forward to 24?
I think the sentiment, both by private equity and corporates, was one of more optimism. Coming into January, particularly coming off the lows that we saw with the peak of interest rates in October, November, and where the markets were and where sales were trending towards the end of the year. Coming into January, we saw a more slower rates, a more activity or approach towards accessing the market. And that on the sponsor side, given they were pretty much sidelined for 22 and 23 other than specific situations. And that went to cost of capital, bid-ask spreads, and also what areas they were going to focus on. The theme for sponsors, I think, is more active. They've got a lot of cash to put to work. Services-focused retail, where they can be more differentiated and grow and leverage versus scaled retail. And I say that from the perspective of the sectors I cover that really require increasing scale, increasing investment in what are commoditized goods. So on the corporate side, I similarly think that a better consumer, lower rates, labor growth, while nominal growth over the last 15 months was trailing while growing was trailing inflation. We had an inflection to positive real inflation growth. So I think from that perspective also, we're seeing the customer and the optimism from both our corporates and from sponsors towards more activity to grow.
The big difference between January 23 and January 24, in January 23, we were looking at still a steep heightening curve in interest rates and what the Fed's going to do and how do we think about exiting our portfolio companies. This year, we're seeing a plateauing of where we think interest rates might get to, and ultimately that we see potential of an easing cycle as we move into the end of the year. And what does that mean in terms of monetizing some of the portfolios that they have, whether that be through sale processes or IPOs?
Let's shift a little bit, guys. As we think about sort of what might portend from a deal environment going forward, when we talk to our clients and we're talking to CEOs, we're talking to boards, we're getting a lot of insight of how they think about things. We're trying to make sure that there's a level of confidence at the CEO level to understand the business, have a good view on what's going to happen on a go-forward basis. And as we all know from the many years that we've all spent in this industry, that's when our clients can make decisions on transactions. So as you think about the discussions you're having today, real time with our clients, where are they focused? Like, how are they thinking about, we've talked a lot about different economic, macroeconomic, inflation concerns. Are geopolitical issues coming into play? Are the elections later this year coming into play? How are they thinking about it? Or are they just looking at potential strategic opportunities as they're coming up and feeling like this might be an environment where they pull the trigger?
Let me take the corporate side, and I'm going to do it on mass, convenience, grocery. And there's two pieces of this. You've got scaled players in these sectors that have competitive differentiation, obviously, from the ability to procure, from the ubiquity, and their ability to invest in technology, and in particular AI. For example, I spent time with the CFO at one major company, and I was amazed not at just the size of their AI team, but the progression of where they are. And Hugh commented on this in terms of driving efficiencies in inventory management, in pricing algorithms, in personalization. And as you think about go forward, I bifurcate larger scale and smaller scale companies within grocery, within C-stores, within a number of these sectors. I believe in retail Darwinism, where we have to grow and we have to both, as I said before, create value for the consumer. How do I do that? Create a better experience. And there's an omni-channel focus on across the sector. And how do I invest and do that and create a much better experience for the consumer? So if you look at the three largest corporates, Walmart, Amazon, and Costco, each of them have a subscription model. And that subscription model is either the membership at Costco, the Amazon Prime, or Walmart Plus. Within that model, they're adding more value. They're creating a more neutralization, if you will, of the cost of delivery or pickup for merchandise. So I reference that because as you move to the other corporates, how are they going to effectively compete long term? And I think as we sit here, and I bring back whether you're in grocery at zero growth right now on the top line and you've got labor and cost growth, whether you're in convenience, while you're strong in CPG volumes or CPG pricing, which is driving cash flow, but you see, we don't know how far out, a declining maturity curve on fuel potentially. How am I going to keep up with the scale players? So the answer going forward is those that are not those three, if you're large enough, is there a capability I can acquire? Is there a ubiquity or a geographic expansion that I can acquire? How can I try to compete with those top three in a way that better measures? And I think that's going to be a theme going forward. And if you think about M&A can be cost-driven, it can be revenue-driven, it can be, just capabilities-driven. The one thing we haven't seen is convergence-driven in retail. We've seen it in other markets. We saw it in Canada with Shoppers and Loblaw and Jean Coutu and Sobeys to try to drive improved efficiencies, better ubiquity with the customer, better loyalty with the customer. We tried to do it here with one deal that was announced several years ago with Albertsons and Rite Aid. And I do think if you look forward, there is the potential that whether that be offline, online, whether that be multi-format. There needs to be a thought process within corporates, and I think they are thinking this: how can I better compete, particularly in an environment where I've got that kind of competition at the top? And it may be 24, it may be 25, but I think we're going to see more corporate activity that tries to align themselves better to compete against what is a very competitive retail environment.
Hugh, maybe on the same topic and building on what Douglas just talked about, as we think about our clients acquiring capabilities, technology is always one of them that we think about. And, Douglas, you mentioned those top three retailers. I mean, there's a popular phrase that's used now in terms of the tracking the largest companies, the Magnificent Seven. I believe that Amazon is the only one in that seven because all of them are technology related in some fashion. So, Hugh, as you think about acquiring capabilities, whether it's technology, artificial intelligence capabilities, which I don't know if we can go a podcast without using that word, how are your clients innovating? Are they thinking about it more from an organic perspective in terms of developing it themselves? Or is time and life too short? Are they going out there and looking to acquire those capabilities?
It's a great question. I think that the one additional one that I'd throw in is partnership. And I think that that's an important piece. I think that, I guess first, organically, there's certain elements that all retailers have to be able to do. They need to have transactional e-commerce site where they're capturing data and analyzing data. I think what we've seen is that the world has moved on. I mentioned kind of the different phases of retail, and we're now at adaptive retail, which is digitalization on steroids, just in terms of how much information you can capture on your customer and use to really merchandise and personalize the experience. And so, bringing it back to M&A is it really depends on where you are within that journey. There are category leaders that have been continuously investing very, very small moves, whether it's in capability-driven acquisitions. We saw it with Walmart and Jet. We've seen Home Depot over the last 10 years investing heavily in digital capabilities and engineers to grow their online presence. And, I think that they've been able to do things to move into further into e-commerce, further into AI, further into personalization, further into digital media and advertising and other revenue streams, growing their marketplace and growing their relevancy. In those cases, those companies are thinking, I already have some capabilities that I've brought in-house. How do I embellish those and really flex those muscles? And in some cases, they're partnerships. Doug McMillon just presented at CES, and he did it inviting the Microsoft as part of the presentation and highlighting all of the partnerships that Walmart has done with Microsoft.
Well, and I guess many of these are responding to Amazon and Amazon's increasing breadth and marketplace power and diversification themselves into such areas as media.
Absolutely. There's another level of retailers that are frankly just, depending on which sector they are, they're growing, but are they really taking market share? Are they taking market share as quickly, or are they just growing merely because of a function of what their categories are doing? And I think those really will feel the pressure, over the next 5 years, over the next 10 years, to make those investments that they may have deferred or delayed, because the gap is widening between the number ones and the number twos. And so we can see that in a lot of sectors. You see it in the valuations within specialty retail and across specialty retail, that there's a real dichotomy between the number one and number two.
So that's been a good summary in terms of what we're seeing broadly in terms of the larger themes across the space. It's great to hear the positives as we enter 24, especially in terms of the growth we experienced at the end of 23, as we just heard today from the GDP figures, and the continued uptick in consumer spending. There are certainly some headwinds, but I think our clients are feeling stronger about their businesses, and especially some confidence with regards to what they're seeing in a forward outlook. And so maybe the growth is not going to be as large as some would expect, but they certainly feel better about what it's going to be. And I think that will portend well for transactions. So Larry, Douglas, Hugh, great conversation. Look forward to continue our dialogue.
Great speaking with you.
Thank you, Vito.
Thank you, Vito.
You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. Join us for more analysis about what's moving the M&A markets in our next episode. If you'd like more information on the topics discussed today, please contact us directly or visit rbccm.com/strategic alternatives. This podcast was recorded on January 25th, 2024. If you're enjoying Strategic Alternatives, don't miss an episode. Subscribe to us on Apple, Spotify, or wherever you listen to your podcasts, and please drop us a review or a comment. Thank you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives. For disclosures, please visit www.rbccm.com/disclosure.